The most common reason people give for not investing is that they don't have enough money to start. And the truth is, that reason stopped being accurate about 15 years ago. You can open an investment account today, put $50 in it, and be invested in over 500 companies by tomorrow morning. The barrier isn't money anymore. It's knowing what to actually do once you log in, and nobody explains that part clearly enough. I'm going to do it right now. Investing feels like something that happens to other people. People who have enough money already. People who understand finance. People who grew up with parents who had a brokerage account and talked about it at the dinner table. If you're in your 20s or early 30s and haven't started yet, you've probably felt two competing things simultaneously. The vague anxiety that you're behind and should be doing something, and the paralysis of not knowing what that something actually is. So you stay in this middle zone where you intend to start investing. You've read articles about it, you've heard people talk about compound interest, but the account doesn't exist yet. And every year that passes in that middle zone is compounding in the wrong direction. Not because you're losing money, but because you're losing time. And in investing, time is the variable that matters more than almost everything else. Here's what I want you to know. You don't need to understand the stock market to start. You don't need to follow financial news. You don't need more money. You need to understand 3 decisions, make them once, and then automate the rest. Let me walk you through all 3 right now. If you feel like investing is complicated and confusing, that's not an accident, and it's not because you're not smart enough. The financial services industry spent decades building products that required brokers, advisors, and minimum account balances of $10,000 or more. The complexity created a moat. It kept regular people out and created the need for expensive intermediaries. That's changed dramatically. Commission-free trading, fractional shares, and zero minimum investment accounts are all recent developments. Fidelity launched zero-fee index funds in 2018. The first fractional share investing for retail investors became widely available only in the last several years. For most of the history of modern investing, small dollar investing genuinely wasn't accessible. The just start investing advice existed before the tools to actually do it cheaply did. There's also an education gap that's structural. A 2020 survey by FINRA found that only 17% of Americans could correctly answer basic questions about how diversification works. High school financial literacy requirements vary wildly by state, and most don't include investing mechanics at all. The knowledge gap isn't a personal failure. It's a curriculum gap that the financial industry has never had an incentive to close. So if you're starting from zero knowledge, you're not behind. You're exactly where most people are, and you're about to close the gap in the next few minutes. Here are the 3 decisions. Once you make these 3 decisions, everything else is a matter of execution. Decision 1. What type of account? Your first choice is between a tax advantage account and a regular brokerage account. If your employer offers a 401k with any kind of match, that's your first dollar. Every match dollar is an immediate 50 to 100% return. Nothing else comes close. If you have access to a match and aren't using it, start there. If you don't have a 401k or have already hit your employer match, open a Roth IRA. Contributions grow tax-free, and withdrawals in retirement are tax-free. In 2025, you can contribute up to $7,000 annually. Fidelity, Vanguard, and Charles Schwab all have Roth IRA accounts with zero minimums. If neither of those applies, a regular brokerage account works fine. Decision 2. What to buy? This is where most beginners overthink. Here's the answer. A total market index fund, or an S&P 500 index fund. That's it for the beginning. These funds hold tiny pieces of hundreds or thousands of companies, so you're diversified immediately. They have the lowest fees of any investment vehicle. And historically, they've outperformed the majority of actively managed funds over 10-year periods. Look for the expense ratio before you buy. That number should be under 0.10%, ideally around 0.03%. VTI, FSKX, and FXAIX are common low-fee options depending on your platform. If you're investing $50 and the expense ratio is 0.03%, you're paying 1.5 cents a year in fees. That's the math. Decision 3. How often do you add money? Set a recurring contribution. Even $25 every 2 weeks. Even $50 a month. The specific amount matters far less than the consistency and the time horizon. Here's why. A person who invests $100 a month starting at 35 and never stops at 35 ends up with more at 65 than someone who invests $100 a month starting at 35 and never stops. 10 years of early start outweighs 30 years of late catch-up at the same contribution rate. That's compound interest doing its actual job. Here's what this looked like for my friend Jordan. He opened a Roth IRA at 27 with $50, set a $75 monthly contribution, and put everything in a single total market index fund. He didn't watch it obsessively. He checked it quarterly. 2 years in, he had just under $2,000 invested, and the account had grown to $2,340, about 340 cents in unrealized gains. He told me the thing that surprised him most was how boring it was, and that boring, he learned, is exactly what you want. Now, I already know what some of you are thinking. What if the market drops right after I invest? What if I start and immediately lose money? This is the most common fear, and it deserves a real answer. Yes, markets drop. They've dropped 20, 30, 40% in my lifetime. They've also recovered every single time and gone on to reach new highs. The people who lost money permanently in the stock market are predominantly people who sold during a crash and locked in the loss. The people who stayed invested through crashes are, on average, significantly wealthier than they were before the crash. When you're investing $50 a month at age 28, a market drop isn't a loss. It means you're buying the same index funds at a lower price. More shares for the same dollar. The down markets of your early investing years are, counterintuitively, the most valuable ones because they're when your consistent contributions buy at a discount. The risk of investing at 28 is real but small compared to the risk of not investing at all. Remember what I said at the start. The barrier to investing isn't money anymore. A $50 bill in 30 minutes today gets you into the market with a diversified portfolio and an automated contribution plan. The thing standing between you and starting is now just the 3 decisions I walked you through. Time in the market matters more than the size of the first deposit. The best time to start was 5 years ago. The next best time is today. If this helped, subscribe. I put out one of these every week and they build on each other. And if you want to go deeper on what a full 1-year financial plan looks like, taking your first steps in budgeting, saving, and investing and turning them into a 12-month roadmap, I linked that video right here. Watch that one next.